Welcome to 1 Minute Crypto. I'm your host, Chronos, and today we're going to talk about 3 hidden costs to trading Bitcoin online. It is so tempting when you see the price going up and down like a roller coaster to jump in there and make a couple of trades. But hopefully, after watching this video, you'll be able to resist the temptation. But first, I want to thank our sponsor because this episode is proudly sponsored by America's Card Room, the online poker site that lets you deposit and withdraw with over 60 different cryptocurrencies. So when you make your first deposit, be sure to use the bonus code Chronos and you'll get up to $50 in free cash. Deposit with your favorite cryptos at America's Card Room. So the first hidden cost of Bitcoin trading online is the fees. Usually the deposit fees and the withdrawal fees are not so much, but the trading fees can really slip by. A typical exchange charges about 0.2% on every trade that's executed on the platform. So that means if you're trading 1 Bitcoin, you're going to have 0.998 Bitcoin after the trade. That doesn't sound like much, but that's why I'm calling it a hidden cost, because over time, if you're doing a lot of trading, it can really add up. Let's say, for example, that you trade once a week for an entire year. Once a week doesn't sound like much, but paying 0.2% over and over every week after a year, that's going to be a 10% loss in your capital. Now, 10% is a lot of money. In this investment world, making 10% a year on your investment is a big return. So taking a 10% headwind is a huge setback to making money by trading crypto. The second hidden cost to trading is called slippage, which is a concept where you're not quite getting the price that you're expecting when you make your trade. Let me give you an example. Let's say Bitcoin is trading at $1,000 and you have a Bitcoin that you want to sell. If you go say, I'm going to sell for $1,000, but you just make a market order, which means take the best price that's on the market at any given time. It could be that the best offer to sell was at 1,000, but the best offer to buy was at 990. That's the highest bid in trading terms, $990. So when you make your market order to take the best offer, you're actually trading at 990, so you're not getting that $1,000. And it gets worse than that if the liquidity on the exchange isn't very good or if you're making a big trade. Let's take that example again. You're selling 1 Bitcoin, but maybe the best offer to buy is only buying a quarter Bitcoin at 990, and then the next best offer to buy is at 985, and it's say a tenth of a Bitcoin, and then at 980 buying another quarter of a Bitcoin. So what happens is your market order walks the order book, which is the process of taking successively lower offers in order to fill the entire order. This is what slippage is all about. If liquidity is not good or your order is very large, you're pushing the price of Bitcoin. Generally speaking, you do not want to move prices when you're making trades because the ecosystem is bigger than you, generally speaking. And so you're not actually moving the price, you're just getting a worse price for your trade. The best way to minimize slippage is to make what's called a limit order, where you set the price yourself. In this example, you would type in the number 1,000. You'd choose limit order and you'd hit submit. Then your order sits on the order book at $1,000. This means you're a liquidity maker instead of a liquidity taker, which has some other perks as well. Some exchanges actually charge a lower fee if you're a market maker instead of a market taker. So that means your order sits at 1,000. When someone comes along and wants to buy Bitcoin, they might place a market order and buy from you. As the market maker, you're getting lower fees and you're not encountering slippage. So placing limit orders is an important strategy to minimizing slippage. The third hidden cost of trading online is your time. And I call it hidden because actually it's an opportunity cost. It's hard to see. It takes a lot of time to watch those charts and really trade well. But another aspect of trading well is keeping track of what's going on in the ecosystem. Recently, there was a rumor out that South Korea is going to crack down on some unregulated exchanges, and that caused the price of Bitcoin to go down. But how true was that rumor? It's hard to tell if you're just reading about it on the internet. And if you dig in and get closer to the source, you're going to have a better idea of what impact that's going to have on the value of Bitcoin. Well, that takes a lot of time digging in there, and keeping track of all the news that's going on in the ecosystem takes a lot of time. And then there's just the time watching the price and entering your trades and sweating about whether the price is going up or down. This stuff takes up a good chunk of your life if you let it. And that's an opportunity cost because it's time that you're not spending with people you care about or working on your house or advancing your skills or advancing your career. You could be doing a lot of good things with that time that could benefit you that you're not doing because you're spending it trading. And you're not aware of that because when you're focused on trading, you're not really thinking about all the other things you could be doing. So that's why it's a hidden cost. But trading Bitcoin well can take a lot of time. So those are my top 3 hidden costs when it comes to trading online. You've got the exchange fees when orders are filled. You've got slippage, which is where you move the price and actually get a worse price than you were trying to get. And you've got your time invested in the ecosystem trying to make the smartest trades possible. I want to hear what you think of these. And if you have any other thoughts on trading, let me know in the comments below the video. I'd love to hear what you think. I'm Chronos. Thanks for watching.